Hey everyone, Todd Uzzell here. Today we're tackling a massive myth in the investing world, the idea that physical gold and silver are the ultimate wealth builders. For many, they're the safe bet, but if you're looking to truly scale, they might actually be holding you back. Whether you're a first-time home buyer or a seasoned real estate investor, understanding the opportunity cost of precious metals is critical. We're going to dive into 10 minutes of data that proves why real estate is the statistically superior engine for your legacy. Don't get me wrong, gold is beautiful, and it's been a store of value for thousands of years, but it's what we call a silent asset. It doesn't work for you. It just sits there hoping for a crisis to make it more valuable. The first reason property wins is leverage. This is the single greatest wealth building tool available to the average person. It's the ability to control a massive asset using a relatively small amount of your own capital. Think about it. If you have $100,000, you buy $100,000 in gold. No bank is going to lend you $400,000 more to buy a bigger gold bar. You're capped by your cash. Simple as that. But in real estate, that same $100,000 is a 20% down payment on a $500,000 property. If that property appreciates by just 5%, you've gained $25,000 in equity. That's a 25% return on your investment, while the gold investor is still at 5%. And because mortgage debt is institutionalized and often tax deductible, you're using other people's money to build your own net worth. Gold investors are limited by their own savings account. Real estate investors are limited only by their strategy. The second reason property wins is cash flow. Every asset you own should ideally be a productive asset, something that pays you for the privilege of owning it. Gold and silver, they're the opposite. When you own a rental property, your tenants are literally paying off your mortgage for you. Every month, you're collecting rent that covers your expenses and ideally puts cash in your pocket. You're building equity while someone else pays the bill. Gold produces nothing. It doesn't pay dividends, it doesn't pay rent, and it doesn't grow. If you hold a 10-ounce bar for 20 years, you still have 10 ounces. The only way you profit is if the price goes up. That's speculation, not cash flow investing. Over a 30-year horizon, the gap between the two is massive. The property owner has a paid-off asset worth millions that generated hundreds of thousands in rent. The gold owner just has the same bars they started with. The math isn't even close. Now we have to talk about the IRS. The U.S. tax code is basically a series of incentives for people who provide housing. Physical gold and silver, on the other hand, are actually penalized compared to other investments. Most people don't realize that the IRS classifies physical bullion as a collectible. That means your long-term capital gains are taxed at a maximum rate of 28%. That's a huge bite out of your profit before you even see it. With real estate, you're looking at standard capital gains rates, which are typically 15 to 20%. For a high net worth investor, that 8 to 13% difference is enough to pay for several more investment properties over time. But the real magic is depreciation. The IRS lets you write off the value of your rental building over 27.5 years. This often wipes out your taxable income from the property, even if you're actually making cash profit. Gold has zero tax deductions. Then there's the 1031 exchange. You can sell a property, roll all the profit into a bigger one, and defer 100% of those taxes. You can do this forever, building a massive portfolio with money that would have otherwise gone to the government. And for homebuyers, don't forget the primary residence exclusion. If you're married and sell your home after living in it for 2 years, you can walk away with $500,000 in tax-free profit. Good luck finding a tax break like that for your silver coins. Now let's talk about something gold bugs rarely mention: the cost of holding the asset. Physical gold and silver aren't free to own. They come with significant hidden costs for storage and security. If you have $100,000 in gold, you can't just leave it on the kitchen counter. You need a high-quality safe, or you have to pay for a bank box or a private vault. That's a monthly or yearly fee that eats away your returns. And then there's insurance. Insuring physical bullion is notoriously difficult and expensive. If your gold is stolen, the loss is total. With real estate, your insurance is predictable, standardized, and often paid for by your tenant's rent. The one thing gold owners always brag about is liquidity, the ability to sell the asset instantly. And it's true, you can sell gold faster than a house, but real estate has a different, more powerful kind of liquidity. Yes, a home sale might take 60 to 90 days, but as an owner, you have access to equity without selling. You can get a home equity line of credit, a HELOC, or do a cash-out refinance and have cash in your hand in weeks while still keeping the asset. When you sell gold for cash, you trigger a taxable event. When you borrow against your home equity, it's tax-free. You get the liquidity you need to reinvest or handle an emergency, and you still own the property that's growing and paying you rent. Let's get practical. You can't live in a gold bar. Real estate has utility value. It's a basic human need. This provides a floor for its value that speculative assets just don't have. For home buyers, your primary residence is an investment that also provides you with shelter. It's a dual-purpose asset. Every dollar you put into your mortgage is a dollar you're not throwing away on rent, which historically rises every single year. By buying real estate, you're locking in your biggest monthly expense for 30 years. Gold doesn't protect you from rising rent. It only protects you if the entire currency collapses. One is a proactive strategy, the other is a defensive gamble. Then there's the issue of verification. How do you know your gold is real? Counterfeit bars and coins are a massive problem in the physical metal world, and verifying purity is a specialized, costly skill. When you buy physical gold, there's always a risk that it's tungsten filled or diluted. To sell it for top dollar, you often have to pay for a professional assay. It's a friction-heavy process that introduces a layer of risk real estate simply doesn't have. Real estate transactions are public record and backed by title insurance. When you buy a house, you know exactly what you're getting, and your ownership is protected by the entire legal system. You don't need a chemical test to prove you own your home. Now, I know what the gold bugs are thinking. What about 2008? It's true that during the financial crisis, real estate took a hit while gold prices spiked. But let's look at the full picture of that era. Yes, gold rose nearly 24% in 2009, while real estate values dropped 27%. But for the long-term investor, that dip was the buying opportunity of a lifetime. The people who held their property or bought more are now sitting on generational wealth. If you sold your gold at the peak, great. But if you held it, you missed out on the massive recovery and cash flow growth of the last decade. Real estate is the engine of growth. Gold is just the insurance for the crash. Especially here in the Arizona market, the case for real estate is even stronger. We have one of the most dynamic and resilient housing markets in the country, and the local growth drivers are powerful. Phoenix and its surrounding areas are seeing massive population growth and corporate investment. This creates consistent demand for housing, both for buyers and for renters, which translates into stable equity growth and strong rental yields. When you invest here, you're not just buying a building, you're buying into a growing economy. Gold doesn't care about population growth or job creation. It only cares about fear. I'd much rather invest in growth. Let's talk about friction. A good investor needs to rebalance their portfolio. Moving physical gold and silver is a logistical nightmare compared to managing a real estate portfolio. If you have a large amount of physical metal, you have to deal with shipping, security, and the spread that dealers charge. It's slow and expensive. Real estate management can be done almost entirely digitally today, with professional teams handling the heavy lifting. Some people think they need gold for diversification, but look at the recommended allocations for most ages. Gold is rarely more than a tiny sliver of a successful portfolio. For investors aged 20 to 40, experts usually recommend about 25% in real estate and only 7% in gold. As you get older, that gold sliver grows slightly for safety, but real estate remains a core pillar. It's the engine that gets you to retirement. Finally, let's talk about the psychology of investing. Gold prices are quoted second by second on the global market. That volatility can be exhausting for an investor. If gold drops 5% today, you feel it instantly. But your house, you don't check its price every day. Real estate provides a level of psychological peace and stability because it's a tangible, long-term asset that you don't need to babysit. When you stack it all up, the leverage, the monthly rent, the massive tax breaks, and the utility value, the case for real estate over physical gold is overwhelming for anyone serious about wealth. I've seen it time and time again here in Arizona. Families who chose property over speculation are the ones who are now retiring early and building legacies for their children. That's the power of a productive asset. If you're truly worried about a total collapse of the financial system, then a little gold might make you feel better. But remember, in a true crisis, you still need a roof over your head. You can't live in a gold bar, and you can't eat a silver coin. I prefer to invest with a 99% probability that the world keeps turning and the economy keeps growing. In that world, real estate is the undisputed champion of wealth creation. Speculating on a collapse is a full-time job. Building equity is a lifestyle. In my own portfolio, I prioritize assets that work. I want leverage, I want cash flow, and I want the tax code on my side. That's why I'm all in on real estate, and that's why I'm so passionate about helping you do the same. There's no better time to start than now, whether it's your first home or your 10th rental property. Every brick you buy is a step towards financial freedom. Let's make it happen together. So to recap, skip the sidebars and buy the productive bricks. Leverage your capital, collect your rent, and use the tax laws to your advantage. That is the path to real lasting wealth. If you found this helpful, hit that like button and subscribe for more deep dives into the Arizona real estate market and wealth building strategies. What's your take? Drop a comment below and let's get a discussion going. I'm Todd Uzzell. Thanks for watching, and I'll see you in the next video.